Good Friday morning, Ted. We are live on all platforms.
Hello, and happy Friday the 14th. It is the Crypto Flight Path live stream coming at you live and direct from the inner tubes, Cryptoverse, Twitter sphere,
Yeah,
Facebook land.
we had a good night last night. We had some nice price action in Bitcoin.
I my armchair analysis of the situation is simply that the the flipping of bias is happening at scale. And if you were structurally short or actually short, I used to always laugh at the fund when someone would say something like, "Oh, we're structurally short the Great British Pound," and I'm like, "What do you mean? Are you actually like selling pounds for something else, or when you say structurally short, is that just finance or hedge funds speak for?" We're trying to tell you that we're short the pound without saying that we're short the pound exactly how we did it because we don't want our trade to get crowded out. Anyway, the point I'm trying to make is I think that there's a lot of like really heavy short positions that are getting unwound, and it has to do with several things. One of them being the liquidity cycle, which is the topic for today, and how money's flowing in a nutshell is that if you were if you had sold Bitcoin, if you became short Bitcoin or you became short crypto, uh, let's say a year ago, uh, you would structure your positions a certain way, and the supply you would be selling supply into the market to be short, structurally or otherwise. And as price has come down through, and it doesn't matter all the things that have helped bring it back down, FUD, et cetera, et cetera, et cetera, or lack of liquidity, namely, and also FUD piling on top. But it has created the conditions where price has settled, and we saw it at the beginning of the year start to move the other way. So it's a function, in my opinion, of short positions unwinding as the narrative changes and as the liquidity cycle starts to ramp up in the other direction. Whereas, and I'll sum it or I'll wrap it up with this to say, whereas liquidity and available capital to to support the market was lower last year, there's now ample liquidity, and there's reasons for that, and we can get into those things.
Yeah, no, I think that's a good thing. I mean, I think it's helpful to think of, you know, kind of all of this is, I guess, maybe a funnel is a good way to say it, right? So you have, liquidity injections, which means all we're saying when we say liquidity injections is money comes into the system, right? That's the easiest way to understand the word liquidity, right, Ted? From a
Yeah,
definition
I guess
perspective.
one way to help think, or one thing that helps me when I think about or one thing that helped me get my mind around understanding what people were actually saying when you hear a talking head or somebody say, "Oh, well, we've got massive liquidity or there's or PBOC, People's Bank of China, has injected 400 billion yuan, so there's a massive liquidity injection." It just means that the central bank, in many cases, has created money out of thin air, placed it into the system for the purpose of shoring up credit markets, meaning making lending available. And what happens when people need cash and they go to the bank and the bank says, "Well, we don't have any." The central bank steps in and says, "We'll provide the liquidity to facilitate this credit expansion." So it's to really, the purpose of liquidity is to make sure that lending can continue even if the institution, the bank in this case, doesn't have the resources, meaning the capital, in house to actually lend to customers like you and I. So think of your local bank. If your local bank doesn't have any deposits to lend because they gambled them all away, for example, which sounds nutty, but we have evidence that this has happened. So imagine your local bank. You go there and you want to get a business loan for $10,000 or $50,000, and they say, "Oh, sorry, we don't have any capital to lend." Well, nowadays the central bank can make I don't know if I'm using the word, they can make credit available in the form of additional US dollars that get printed and magically keystroked into existence. and say, and made available to the local bank, and the local bank can say, okay, here, I can facilitate your loan now. And the borrower takes that money and it lands in their account, and they go out and they spend it and they buy things, and this keeps capital flowing in the economy, and people are able to continue to transact, are able to buy supplies, pay employees, and so that's where it ends up. And but how does this pertain to risk markets or capital or crypto markets or equities? Is that a lot of times when institutions like hedge funds and other money management firms will borrow money that's made available and take credit and put that to work in the market. So what I'm trying to say is that when credit is made available to lending institutions from central bank liquidity injections into the system, it makes its way into the accounts, to the hands of participants a
Well,
lot of
yeah,
times. And
and
yeah,
I think that's a great explanation, right? And just to kind of give people a understanding of what we say when we say liquidity, I mean, these central banks operate globally, right? So you can have a situation like we have right now where the Chinese central bank is injecting liquidity into their economy, and the United States technically is not, right? So these markets being global, these crypto markets being global, benefit from global liquidity. Okay, so it's interesting to understand because, and it's relative to crypto, because anymore all markets are a function of liquidity, right? That's it. Like if there's more liquidity in the system, there's better results in the markets. Not on a, it doesn't, it's not on an individual crypto or stock price, but in general. Is that fair to say?
yeah, it's not based on valuation necessarily, and this is where
Yeah.
people get a little confused, myself included in the past. Is that we used to think that when when the a rising tide lifts all boats. The as look here's where it gets real. Is that when central banks, whether they're here in the U.S. or outside the U.S., because the financial system is global now, and stocks or assets, risk assets like stocks and bonds and currencies and crypto can be you can participate globally. If a bunch of extra buying power shows up in the form of liquidity injections into the system, this what you have to remember is when the central bank is printing more money, that just means that the supply has gone up, and that means that by default, because the purchasing power of that particular type of money went down, that the valuation of the assets automatically goes up without them actually becoming any more valuable. You
Yeah,
understand? Hopefully, I'm
that
making
does.
this get okay.
Yeah,
So
yeah.
what I'm trying to say, to put a button or put a bow on this, is that simply because prices move in the upward direction necessarily doesn't mean like a stock. I mean, a Google stock may rally 10% because there's just extra money in the system that people need to put to work somewhere. So they kind of like roll the dice, and this is where the gambling analogies come in. Is that they just kind of like pick a sector, or they pick an ETF, or they pick an index, and they just put it all on that because they understand that the valuations are going to get raised because the purchasing power of the monetary unit has gone down, not because the company has generated more revenue or has become more valuable, has edged out or has a new and exciting edge in the marketplace competitively or something to that effect. And that's where, I mean, it works both ways though. Is when
Yep.
credit is tight, and I'll finish up with this. When credit is really tight, which is usually what kicks off these like recessions, and when lending dries up, all of a sudden valuations come way down because people don't, there's literally not a lot of cash or a lot of excess capital laying around. So if people want to sell some stock, they have to sell it at a discount. So you'll hear analysts perhaps and others talking about stocks that are undervalued and they're trading below their valuation. That just means that typically there's not enough capital available for people to buy the stock at the valuation price. They have to buy it at, say, a 10 or 25% discount, and you say, well, I'm going shopping, I'm buying some good companies. So in the same way that just because a stock price goes up doesn't mean that a company got more valuable intrinsically, it's the same thing on the downside, is that just because Google stock might come back 20% or 10% doesn't mean that it isn't always the case that they had lower revenue or their forecasts were lower or they lost some market share or something like that. It's often nowadays, because of the way central banks or the financial system works, it's simply a matter of how much money is available in the system and whether it's being added to or subtracted from through an easing cycle or a tightening cycle.
Gotcha. No, I mean, and a really important thing to understand. Especially if you're just new to all this, is like what really helped me get into crypto when I first started was understanding like a global kind of 30,000 foot view of what central banking was. Before I got into crypto, I had no idea central banks even existed. I read a book by Mohammed El Areen, I think is his name. He's always on CNBC. It's called Central Bankers, the Only Game in Town. And I read that book. This is probably 6 or 7 years ago, and I was like, "You got to be kidding me! This is what this is." And so you have all of these markets are reliant and kind of follow these liquidity injections and these credit crunches, right? So interesting spot we're in right now, and I think that dovetails great to our first tweet that we wanted to bring up in concept. This is a guy named Tech Dev on Twitter. He's always got some interesting analysis. Not always right, but no one ever is. So I thought it'd be interesting. This ties in kind of well to what we're talking about. And what he's saying is it's hard for me to ignore the clear impact of the 3.5 year liquidity cycle on Bitcoin's price. While many are still looking to the next halving event as starting signal for the next major leg in Bitcoin, to me, we saw this signal back in April, which indicated the start of the next liquidity cycle, right? And that's what he's talking about. These liquidity cycles operate in typically 3.5 year cycles, and this is something you can see with his chart, which is that's the Chinese yuan compared to the dollar, right? As that's the chart we're
Yeah.
looking at there. And so what he's saying is essentially that these Bitcoin halving cycles have been maybe coincidental in relation to major Bitcoin highs, and what the real factor might be is what we've just discussed, these liquidity cycles that happen every 3.5 years. So, what I'll go on to read, after each of these 5 prior signals, Bitcoin has taken no more than 12 months to put in a major top. Though history is never guaranteed the future, it's only a probabilistic guide. This work has led me to conclude that the placement of the halving events and their apparent impact on price has likely been coincidental, as Bitcoin began at the start of one of these liquidity cycles following the 2008 crisis. So, interesting to think about this, and what that means, Ted, is that if this is right, then you have a Bitcoin cycle top coming sooner rather than later, and this is something we've talked about relative to a left translated cycle too. Now, I don't know if that's going to happen or not happen, but I think it's important to watch. And that would surprise a lot of people that are caught in this Bitcoin halving narrative.
Yes, this thing that you're show or this chart from TechDev here points out a really important thing, is that without peering into the macro looking or through the macro looking glass, if you're strictly a Bitcoin focused person or participant, I should say, it's been really easy to look at the halving events as the things that have dictated, or I should say that, in hindsight, of course, remember, this is all, we're looking back and we're able to make these charts. And the interesting thing is that when you and I'll bring up Raoul Paul here, because he talks about the 3.5 year liquidity cycle as well, and it has not, and he makes the same type of, he suggests the same thing, is that the Bitcoin halving events don't have anything to do with the cycle that we've seen, and it has everything to do with the fact that the debt refinancing that has to occur, meaning like the national debt, like all of this, the debt based system we live in now is that in order to facilitate the repayment schedule to and the interest payment schedules, that interest rates they're allowed, or I should say allowed. They raise rates and then they cut rates because they have to in order to make the debt refinancing possible. And it creates fertile ground for these crisis scenarios where when rates are very, very low and lending is cheap and capital is cheap, thinking in terms of like buying money on sale, meaning the cost of your capital. Like if you go to Home Depot and you want to buy a washing machine and they mark it down by 20%, man, everybody's excited and they'll buy it. And it's the same thing if you want to borrow money, and if you can borrow at 5% one year and then Fed Fed gets into a pickle and we have to all of the machinations of the political apparatus and the monetary apparatus get together, and the media, they all confluence and say, oh, we got to cut rates for whatever reason. Cut rates, all of a sudden money gets more, it's more attractive as something you can buy, and it creates this situations where it's really easy for large numbers of people and institutions with a lot of good credit and good lending, they're good lending risk. They borrow vast sums of capital at very low rates and put it to work in financial markets and make a return that often eclipses and outpaces the cost. So if you can borrow at 1% versus 5%, and you can earn 10% just by being in the S&P, why wouldn't you scrape that arbitrage all day long? Borrow at 1%, buy the S&P 500 and get on average 10% year over year, and you're sitting there doing nothing, making roughly 9%. I mean, do the math separately, but it's a no-brainer, and for a
Yeah,
lot of
yeah, and I
participants.
think I just think that this is important to look at when you're doing your crypto, when you're in, you're starting a crypto journey, and you're trying to figure all this stuff out. I mean, it might be helpful to understand that, look, this is just a small section of a much bigger game, right? And so there's aspects about cryptocurrency that are very promising and very, very unique, as relates to traditional stocks and privacy and freedom and all that stuff. But as of right now, we're still a small fish in a big pond, right? And there's a lot of factors that go into these prices that go up and down. And right now, it looks like we're, according to Tech Dev, we got the signal that the start of this next liquidity cycle happened in November. Okay, and so this has happened 5 times before, and each time a new all-time high happened 5 to 12 months later. So something to pay attention to, something to watch. And another thing too, with like those new, once Bitcoin hits its all-time highs, typically it's 2 or 3 months before you get the blow off top. And so you can kind of look at stuff like that and say, all right, engage. If Bitcoin runs up the rest of this year and is at all-time highs plus at the end of this year, I know it's hard to kind of conceive right now just based off mentalities and everything that's happened in the last year, and it doesn't add up with the previous cycle. But I'd probably be in a position where I'd take a lot off at that point, even if I miss some upside. I would hate to be caught in a situation where the 4-year cycle narrative breaks, you get a run up, people get too excited, and I could see it being a perfect retail trap, because that narrative, the 4-year narrative, will still be in everybody's heads, and they'll say, "Oh, we're at 100K, and we haven't even hit the halvening yet," and then you'll have everybody again mortgage their homes, jump in late, and it'll crash back down to 30 or 40,000, stay there for a couple of years, and who knows, right? Like, and who knows, this is
Yeah.
just a scenario. I don't know if this will play out. I think it's important though, because we were talking about liquidity. I think it's important to kind of bring up and talk about. And so the next thing I want to talk about is we've got our buddy Rec Capital up here. And so this is the crypto money flow cycle. And so what we've seen happen here is we've had fiat come into Bitcoin. We saw the Bitcoin price go up. What we saw last night was the money is flowing into large caps. I'll be Ethereum is the main one there, and what you'll see is that there's a money flow cycle within crypto. So liquidity gets injected into the system. You know, fiat money comes to Bitcoin. Bitcoin price goes up. Bitcoin dominance, which we can show on this next chart from Income Sharks, Bitcoin dominance will rise, and Bitcoin dominance is a measure of Bitcoin. I guess, how would you describe Bitcoin dominance, Ted? I'm having a hard time articulating.
My normie brain, when I hear Bitcoin dominance, I mean, I would categorize it in my, or I do categorize it in my own mind as simply the strength of Bitcoin compared to everything else. Meaning, if you're trading, or if you're looking at trading pairs like ETH to Bitcoin, meaning Bitcoin's the denominator and not US dollars. So if you're trading, uh, or excuse me, if you're pricing Ethereum in Bitcoin, or you're pricing other tokens like Solana in Bitcoin, they basically, what I think Bitcoin dominance tries to tell the market, or it tells the story of what the market is saying, that compared to other crypto assets, Bitcoin being the biggest market cap at present, is how is it being priced in these, or how are other tokens being priced in this, in Bitcoin, and is Bitcoin diverging to the upside or to the downside compared to these other crypto assets? Meaning, you're looking at the strength, relatively speaking, of Bitcoin compared to the others. That's the simple way in my mind of understanding the idea of quote unquote Bitcoin dominance.
Yeah, okay, so here we've got a definition. It's a percentage value that is calculated based off Bitcoin's current market capitalization divided by the global crypto market cap. Okay, very simple. In my mind, I was getting it confused. Okay, yeah, it's just all it is the Bitcoin, market cap divided by the total crypto market cap. So when Bitcoin dominance rises, what you typically see is Bitcoin price increase. Okay, and altcoins tend to kind of bleed out against that. And if we go back to Brett Capital's crypto money flow cycle, what happens when you get Bitcoin dominance, meaning the altcoin market cap starts to rise in comparison to Bitcoin's versus the total crypto market cap, you start to see money come into large caps, mid caps, and that's when you start to see what we call alt season, right? And money start to come into some of these smaller cap cryptocurrencies. Does that make sense to you, Ted?
Yeah, I think it's very interesting to start to look down the rabbit hole a little further, to understand the relationship between availability of credit or fiat money availability to be put into risk markets, whether it's any risk market. And I'm not picking on Bitcoin, or I'm not picking on crypto here, but across the board, we could be doing the same analysis for foreign exchange. We could do it for large cap stocks, mid cap stocks, different sectors, different countries. The stock markets in Europe, the stock markets in Asia, the stock markets in the U.S. It doesn't. I'm not. I'm saying this is somewhat agnostic in a manner of speaking, because the money does flow in similar ways, and this is just really. I think it's really important, and this really. The point I'm trying to spit out here is that the saying that you might have heard before is that if you don't do macro, the macro will do you. And where I think that applies, or why that's important for normies to understand, is that th- you said something earlier about us being a small fish in a very big pond still in this crypto ecosystem and this asset class, and I believe that's accurate. So the thing is that we as people, we are a species with amnesia, and it's very easy for us in large numbers to forget what happened. Or what I'm trying to say is that the normies, they're the ones that usually get caught holding the bag when there's a blow off top, unfortunately, because they just don't have any. And look, not everybody's into this. Not everybody has interest in learning and understanding like macroeconomic pressures and forces and central banking and all this other crap, interest rate policy. Who cares? Got life to live. The point I'm trying to get to is that the if you're seriously thinking of participating in any markets, much less crypto markets, it's a good idea to understand the things that influence them at scales that are hard to comprehend. And we're talking about here is globally, and central banking, which is enormous. They have enormous power, and they affect literally billions together. They affect billions of people with the stroke of the key or the stroke of the pen or the syllables that cross the lips can cause things to happen in ways that you just it's hard to wrap your mind around. So that's kind of my point, is that if to help make sense of some of this, it's good to develop, in my opinion, an understanding of basic concepts like how money flows through the system. And I think the rec capital chart here helps turn down the noise on some things and understand that money, I'll just say it back as I see it, is fiat flows into Bitcoin, and then there is a cycle here, and we're at a phase now where Bitcoin and Ethereum are starting to move up in price, meaning capital is flowing in, so there's large inflows, and as others start to catch up, in a manner of speaking, people will rotate out of people will traders will take profit in their Bitcoin positions and roll them into others long positions into other smaller caps that haven't moved up because the risk reward tends to be greater. And this, as we round out the cycle here, and then eventually it reaches a point like the on the other chart where you reach after a certain point, price has moved up, the risk reward's no longer good from a trading perspective, or it's not ideal to be long, and people start to close out the long positions and rotate back into fiat money, and or go short and using derivatives or however they choose to do this. But there's a rhythm and a cycle to this that we probably should be
That's
paying attention to.
That's right. And so I think what people that are new need to understand is this all isn't as random as you think it might be. You know, there are reasons why, you know, these Bitcoin and crypto markets react the way they do. And it is cyclical in nature. You know, is it centered around the 4 year halving? Is it centered around the 3.5 year business cycle? I don't know. Probably, you know, it may be a little bit A, a little bit of B, but uh, there really is a cyclical nature to this, and there are patterns that emerge within these markets that you can kind of analyze and help you make decisions along the way to the best of your ability. Now, you know, just because all this stuff happens doesn't mean you're going to get in and pick, you know, a winner based off, you know, the liquidity cycle, right? Like, it just doesn't work that way. But there's still a lot of work to do relative to individual projects, teams, you know, tokenomics, all that stuff when you get into investing in different cryptos. But as far as Bitcoin goes, I mean, this is a pretty simple way to understand it. When you get liquidity into the system, that benefits Bitcoin greatly. And so it really is a check on, you know, these governments injecting liquidity like crazy. It's more of a measurement tool, right, than anything. Like you know, you can measure when there's more liquidity in the system based off the Bitcoin price.
Yeah, and you know, I think what is it? What's a good takeaway from looking at quote unquote liquidity? I think one important thing to take away from this is to remember that the debt-based system that we are in today, where central banks control the supply and can change the supply of available monetary units that the public can earn and spend and save and invest by raising rates, lowering rates, doing quantitative using capital injections, selling, buying bonds, and adding assets to the central bank's balance sheet, which is a tricky one because they create the money and then they use the money to go out and buy assets. So imagine if you or I tried to do that, we'd be arrested for counterfeiting and put in jail. So I'm not. That's not political commentary. I'm just making a comparison to so I help you understand how. I mean, the Swiss National Bank is a great example of a sovereign entity that can create its own money out of thin air, and they have the sovereign wealth fund, and they were one of the biggest buyers of U.S. stocks for years, and don't take my word for it. You can Google yourself till you're blue in the face to learn more about sovereign wealth funds and how central banks produce money out of thin air to buy assets. And the Japanese are a great example of a central banking entity that effectively keeps a statistically significant portion of their corporations afloat financially by continuing to buy the bonds that the companies issue. So that, meaning they issue, it's like issuing shares. They say, here, I promise, here's an IOE, I promise I'll pay you back. Now give me this money so I can operate. And that's where this idea of zombie companies come from, that they're not solvent in the traditional sense. They're the only reason they have money to spend on payroll and other things is because the government is buying their is giving them money in return for an IOU. And because the money was created by the entity that could create the money, and it didn't have to come from somewhere else, it's almost too easy. And but it's happened. I mean, I'm learning about this stuff after the fact. I mean, this has
Well,
been going on for
there,
years and years and years.
yeah, there's a lot of stuff like that that happens, right? And like people take advantage of this stuff, right? Because at the end of the day, it's not that complicated, right? You know, in the past, people used to have to, you have to have a Harvard business degree or finance degree to understand macroeconomics and all this stuff. I mean, that they use big words on purpose to try to confuse, and not even the fact that they're big words. They're words that like don't even mean like, okay, liquidity, like, okay, great, like and I don't know, I can't think of any. I don't use the words to understand them. I use the way I understand stuff. They put a shit ton of money in the economy. That flows into stocks and Bitcoin. Price goes up, or value of asset, becomes more because there's more money in the system. That money goes to large caps. That goes to mid caps. You pick the mid caps before this happens and you sell when they go up. I don't know. Like, to me, maybe that's too simple. The smooth brain over here can't figure out, like, and then you watch these people on CNBC and they're like, liquidity, derivatives, blah, 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 blah. It's like, and most people are like, their brains turn off. Well, your brain turns off with that stuff for a reason. They don't want you paying attention to it, right? Because once you figure out what it is, it's like, all right, well, these guys aren't necessarily that sharp, right? This stuff isn't super complex. They just use goofy words to describe it, right? Like,
Yeah, it's kind of ridiculous.
now it is
The
complex. When you get into euro dollars and tracking money and all that stuff, and euro dollars is just a dollar that exists outside the United States banking system. Why they call it a euro dollar, I have no idea. But like it's another one. But like now, don't get me wrong. This whole thing is very complex to try to understand it. But it's not that complex to where you can't get a grasp of some general concepts that like liquidity or 3.5 year business cycles and stuff like that. Like these things aren't that hard to understand. At first it's overwhelming, but the whole point of my little rant there is like don't be intimidated if you get into this stuff and you start reading this stuff and it's like alien talk. It's really not that hard. I mean, all you have to do is take these words and just Google what they mean, and you'll be like, oh, that's what that means. That's not really that big of a deal.
Yeah, I'll sum it up with this. All of these complex things that you hear strewn about the media, it's mostly smoke and mirrors, and a lot of people just want to sound smart. It helps validate their existence. It helps validate the fee for their participation in whatever it is they do. The end of the day, all these complex things are made up of much smaller, simpler component parts. And if you like the saying is, oh, how do you eat the elephant? And the answer is one bite at a time. So if you start with these, if you hear people throwing around all these complex jargony words, start simple and look at understanding what liquidity is, for example, and just get a basic understanding of a layman's terms understanding of when you hear that next time you think, oh, okay, I know what in broad strokes. You don't have to understand these things to the nth degree. Like the saying is, you don't have to know how the watch was made to know what time it is. If you understand that liquidity is coming into the system, that's usually enough to help you make a decision about like what action you're going to take or whether you're going to take any action at all. And as you start to develop a bigger and bigger and bigger understanding, or I should say, a more broad spectrum understanding, you can then start to see patterns. So what I'm encouraging people to do is think in simple terms, because even the most jargon filled mouth like on CNBC, nobody came out of the womb understanding these things instinctively. They all had to learn, and through some repetition, now they're wordsmithing to a certain extent. And the media, it's all about storylines and selling products anyway. Okay, so you got to take it with a grain of salt, in my opinion. Anyway, but the point I'm trying to really drive home here is simply component parts, liquidity, blah 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 blah. Insert buzzword term here into Google and understand it in its simplest form, and then you understand. Then it helps you start to make sense of what this these seemingly daunting things like global macroeconomic conditions. What does that even mean? It just means stuff that's happening around the world with people's money, and the money changers and the money producers, and the way people buy it. At the end of the day, people are just buying and selling things all day long, 24 hours a day in some currency, and they're swapping it into another perhaps at some point, and they got to figure out what to do with the excess currency that they have. And it's not really. I mean, if I can learn to speak quasi intelligently about these things, even at the very limited capacity that I have to do so, then there are a lot more. There are a lot of other people in the world that if they take a little bit of time can start to get their minds around these things and be less intimidated by what they see in the news.
Yeah, and look, some days this stuff's going to come easier than other days. Some days you just, the way my brain works is some days I wake up, I get it, like it's like clairvoyance. It's like okay, it all makes sense. And other days it's like I don't understand any of this anymore. Like and I think that's fairly normal, right? Like that's the game we're playing because there's constant information flow coming in. There's new things changing. But like yeah, it's like Ted said. Like if you can understand this, take all of these things and reduce them to their simplest forms, and try to understand it in a way that works for your own brain. My brain's different than Ted's brain. I understand things in a different way than he does, and we both understand it the same. It's just we get there differently. So don't be intimidated by this stuff. I thought this was a good kind of. It's somewhat complex to talk about, but the idea of liquidity entering the system. We're on 3.5 year business cycles, and then how that liquidity flows into the crypto market, right? And so how that injection of liquidity into these business cycles, Bitcoin benefits from that. Then you have Ethereum, and then you see how the money flows to mid caps and low caps, meaning ultra shit coins, right? Like but that's just how the crypto market works and how the overall business cycle and liquidity impacts the crypto markets. And so we'll see, is it going to be a 3.5 year business cycle like the tech dev chart, or are we still on the 4 year halving cycle with Bitcoin? Don't know the answer yet. We're going to find out. About to learn soon. So we wrapped it up with Bitcoin dominance and just a discussion on trying to understand some of these jargon words that you hear on the media. When you're trying to understand this stuff is not that complicated. These words are kind of smoke screens to, I think, get people to be bored with this stuff. I don't think at the end of the day, people really want, these central banks really want everyone understanding what they're doing. Because I forget who it was. Was one of these presidents said it, it might have been Henry Ford, maybe not, or Roosevelt, or one of these guys that said, if the people knew how the money worked, there'd be blood in the streets tomorrow. So I think a lot of this obfuscation is done on purpose. So don't let it intimidate you. This stuff is a lot at first, but it begins to make sense the more you stick with it. So I think that's a good place to wrap it up for today. Any last words,
Agreed.
Ted?
Uh, just remember, um, over the next decade, this liquidity thing is going to happen again and again and again. And there's one asset in particular that was designed to protect your purchasing power that continuously gets eroded. And we all know what it's called, Bitcoin. And do your own research, and we'll see you in the next one.
Sounds